Hi everyone, it's Paul Tilley and welcome to Unit 5, Managing Retail Business Community Customers. Today we're talking about Part 1, and Part 1 is found in 9, 10, and 11 chapters. We're going to be looking at the customer relationship management in the retail environment. Okay, so what we mean here is where we contact the customer. So in Part 1, we'll understand the environment in which the retail sector operates, how to analyze economic viability of an online firm, the challenges faced by online firms, the major features of the online service sector, and discuss the trends that are taking place in that industry right now. So, what is online retailing? Well, it's perhaps the most high-profile e-commerce business. It's the eBays of the world, or the going in and buying something online at any website. And over the past decade, it's really become popular. It is not huge, though. It's about 11% of the total retail industry, but it is growing. It is a sector that's certainly growing, and the COVID epidemic has certainly pushed it even ahead a lot further. So we're going to see a lot of growth in the future. Well, there's a whole bunch of trends, in terms of this, and I've listed off a couple in these slides, and I just wanted to kind of focus on a few of them. COVID-19, as I say. Mobile technology is really pushing it. People are ordering stuff from their phones and just everywhere and anywhere they are. Um, got some serious traction because of social media. Facebook and Pinterest and the like has certainly driven it. And lots of retailers and buyers out there increase. It's a market that's growing, not only from the buyer's perspective, but from the seller's perspective. And it is something we're going to see a lot. And I guess realistically, it's become normalized. That's the key thing. People are doing this all the time, going out and buying stuff online. As well, the increased selection of goods online, that's something we're seeing a lot more items and things that we never thought of, like furniture and groceries. A lot of specialty retailers growing up. These are some of the major issues that we're looking at. We're also seeing retailers put a lot more interactivity into their sites. So things like Zoom and color switching and being able to change product configurations, these sorts of things are becoming more popular, so people can actually try the stuff on virtually. And as I say, a lot of these merchants are adapting to this new technology, and a lot of it is driven by big data. We collect thousands of bits of information on people when they go to these websites, and retailers are using this to their advantage. I've included this graphic here to show you, just to show you what is really being selling online. Computers are way up there, apparel and these sorts of things, but we're seeing other items, the lesser items, growing. Toys, food, these sorts of things are starting to pick up as we move along in terms of the basic timeline. So a lot of research is going into what is it that is required, what's the magic to make a firm viable in an online environment. And economic viability refers to the ability of a firm to really survive and be profitable in this environment over a period of time. Essentially, there's two analytical tools that's used. First of all, there's a strategic analysis, and second of all, there is a financial analysis, which looks at the dollars and cents. So we'll look at these now. Michael Porter is renowned as being the man who developed this concept of strategic analysis, and he brought up 5 big factors of analysis that we look at from a strategic perspective. We look at things like barriers to entry. How hard is it for competitors to get into the business? Is it really hard or not so hard? And that will determine whether the business is successful or not. We look at the power of suppliers. How much influence do suppliers have over a company? A lot or a little bit? Again, if they have a lot, that lowers the ability of the business to be successful. Power of customers. How important are customers? What influence do they have? The existence of substitute products. Lots of substitutes means that the product that the company is selling is easily replaced and makes it not so competitive. And the nature of the intra-industry competition. So we're looking at competition within the industry, and how is our product different than anyone else's? What makes ours stand out, more or less? So those 5 factors are often used as an analytical tool to assess whether a business will succeed or not. From a practical level, certain strategic features hold out that kind of indicate or give indication of how successful a firm could potentially be. We look at how much value is added by the firm, the firm value chain. We look at what its core competencies are. What does it do really well? What does it do better than any of its competitors? Its synergies. What can it do to get 2 and 2 equal 5? What advantages it bring in terms of being able to make the magic recipe work well? Technology. What kind of technology does it apply? Is it new? Does it cost money? Does it save money? Does it provide value to the customer? And what are social and legal challenges that could potentially interrupt the business in terms of its future, or what could potentially bring it forward in terms of its future? The second major type of analysis that's used in order to assess whether a firm will be viable is a financial analysis. And effectively, financial analysis helps understand how the firm is performing. It really has two major components. First, there's the statement of operations, which is really the income statement. How much money is the firm generating? How much is it costing to provide those sales? And the second is the balance sheet. And the balance sheet really tells the value of the assets of the firm and the value of its liabilities and owner's equity. So it kind of assesses where the firm is at a given point in time to assess its health. So from the perspective of the income statement, or a statement of operations as it's called here, we look at things like revenue. Many e-commerce companies have experienced impressive revenue, or in fact explosive revenue growth, and we want to know where that money is coming from. We look at relative to revenues, what are the costs of the sales? Costs are typically related to the sales, and the more you sell, the more your costs are. Are we getting our costs down relative to our sales, becoming more efficient? And our gross margin, which is really calculated by dividing the gross profit by the net sales. So how efficient is our business? So gross margin really tells us the firm is gaining or losing market power vis-a-vis its key suppliers. So again, from a strategic point of view, is it powerful over its suppliers if it can be more efficient at making money? On the expense side, we have to look at firm statement of operations, look at the expenses. What are the operating expenses? They typically include cost of marketing, technology, administrative overhead. And we want to know, is it really being put to good use? Using an operation margin, or operating margin, is calculated by dividing the operating income or loss by the net sales revenue. Again, a measure of efficiency. Operating margin is an indication that companies' ability to turn sales into pre-tax profits after operating. So it tells us that the firm's current operations are covering its operating expenses, how much it's covering, and just getting a sense for, again, efficiency. So that's an important tool to assess the financial health of a firm. Again, another tool in the financial analysis toolkit is the net margin. Net margin really tells us the percentage of gross sales revenue that the firm was able to retain after all its expenses. So it's really, what are we making in terms of the money? So net margin sums up in one number how successful the company is at doing what it does at making profits. And it tells us something about efficiency. And again, we're always keen on efficiency here for this sort of thing. We also need to look at the balance sheet with regards to financial analysis. And what we're looking at there is, are we using the assets of the business well? So assets refer to stored value. And our current assets is the stored value that can be converted into cash within one operating cycle of the business. So stuff that's pretty liquid. And obviously, if we look at current assets and we compare it with our current liabilities, which are bills that are come and due within the operating period, we can get a sense when we compare the two of the business's ability to pay its bills, right? Does it have more assets than liabilities? So for a quick check of a firm's short-term financial health, just compare the current assets with the current liabilities and ask yourself, do we have enough to pay our bills? And if we do, we're doing well. And over the longer term, is that gap growing or shrinking? Now let's switch to look at the different types of online retailers. Generally, there are four broad categories. There's omni-channel merchants, which make up really about 31%. These are companies that use both online and physical presence. We have virtual merchants, which are 100% online. And if we look at virtual merchants, they're about 45%. Catalog merchants, which is traditional catalog, is about 8%. And manufacturer direct, which accounts for about 16%. So if we look at the major features of the online service sector, really, we think the major players are industry groups like financial services, insurance, real estate, business services, and health services. And within the service industry groups, companies can further categorize or subcategorize into specific types of services, value added, that are generally in information-based industries. So e-commerce really offers a host of opportunities for these to be able to market using information technology tools such as e-commerce. Now let's just break down the different types of retailers. Well, in terms of omni-channel merchant, bricks and clicks we call them because it consists of real actual buildings plus an online presence. They have network and physical stores as their primary retail channel, but also they have online operations. Their real challenges include high cost of physical buildings, high cost of large sales staff, need to coordinate prices across the various channels, the need to develop methods of handling cross-channel returns from multiple locations, building a credible e-commerce presence, hiring new staff, rebuilding rapid response order entry, and fulfillment systems. So Chapters Indigo is a good example of this, and they've had some of the challenges. They've been dealing with the challenges for over 20 years. We've got virtual merchants, which are single-channel e-commerce firms that generate almost all the revenues from online sales. Their challenges include building a business and brand name quickly. Many competitors are existing in the virtual market. There's substantial cost of building and maintaining an e-commerce presence. There's considerable marketing expenses, large customer acquisition costs, steep learning curve, and a need to quickly achieve operating efficiencies in order to preserve profit. Amazon is a classic example of a firm such as this. Another type of online retailer is the catalog merchant. The catalog merchant is really an established company that has a national offline catalog operating as its largest and primary retail channel. But they also have an online capacity. So their challenges include high cost of printing and mailing for these catalogs, need to leverage your existing assets and competencies to the new technology, and the need to develop methods for handling cross-channel returns, building the e-commerce presence, and hiring new and skilled staff. Mercer's Marine, Land's End, all good examples of the catalog merchant. In terms of manufacturer direct merchants, sometimes known as D2C or D2C, or sometimes known as D. In terms of manufacturer direct merchants, also known as DTC or D2C, direct-to-customer sellers, they're either a single or multi-channel manufacturers who sell to customers directly online. So their challenges include channel conflict. Do I buy it by a store? Do I buy it directly from you? Quick developing rapid response, online ordering, fulfillment system, switching from supply push, products are made prior to order being received, to demand pull, which is where the products are built to order, and creating sales, service, and support operations. So Dell is a good example of this type of business. In terms of online travel agencies, the internet has become the most common channel used for customers to research travel options, seek the best possible prices, and book reservations for online tickets, hotel rooms, rental cars, cruises, and tours. Online travel sites offer customers a one-stop, convenient leisure and business travel experience where travelers can find content such as descriptions of vacations, facilities, community, chat groups, for example, where people who've been there can tell other people how it was. Commerce, purchase and travel elements, and customer service, usually through call centers. Online sites offer much more information and many more travel options than traditional travel agencies. For example, the owners of hotels, rent-a-cars, and airlines, the online sites aggregate millions of consumers into a singular focused consumer pool that can be efficiently reached through on-site advertising. Online sites create a much more efficient marketplace, bringing customers and suppliers together. Online career searches is yet another one. Next to travel services, one of the internet's most successful online services has been the job search services, or recruitment sites. These provide free postings to individual resumes, plus many other related career services for free. And they also list job openings posted by companies. Online recruiting provides a more efficient and cost-effective means of linking the employer with potential employees while reducing the total time to hire. Online recruiting enables job hunters to build, update, and distribute their resumes while gathering information about prospective employers and conducting job searches. Online financial services. E-commerce is nevertheless transferred to banking and financial services industries. Major institutions have developed their own online applications to serve and increase connecting with online customer base. Insurance has become more standardized and easier to purchase online. Although security is still a concern, consumers are much more willing to trust online sites for their financial information than they used to be in the past. We also have on-demand service companies, and these on-demand service companies provide a platform that enables on-demand delivery of various services by connecting providers and buyers. So that would include things as cars, rooms with beds, ability to perform various services via personal labor with customers. The platform. These services collect a fee from both sellers and buyers for using the platform. In the last few years, hundreds of startups created a whole bunch of platforms that allow owners of resources that are underutilized to sell them to people who are looking for them. Airbnb is a classic example of that.